A special thank you to each of our subscribers who make this channel possible. Here's today's story. In a significant economic challenge, Chancellor Rachel Reeves has been cautioned by leading economists about an impending, impossible trilemma as she prepares for the upcoming autumn budget. The National Institute of Economic and Social Research, (NIESR), has indicated that she must either raise taxes or abandon her flagship borrowing rules to address a staggering £41 billion black hole resulting from Labour's recent policy U-turns, increased borrowing, and a sluggish economic climate. The think tank has suggested that spending cuts could also be a potential avenue to generate the funds necessary to rectify the £41.2 billion shortfall on her stability rule by the fiscal year 2029-30. However, with significant cuts already implemented in last month's spending review, the expectation is growing that the Chancellor may have no choice but to increase taxes. The Labour government's manifesto pledge to avoid tax hikes on working people further complicates the situation, leaving Reeves with a narrow set of options. Potential tax increases under consideration include extending the freeze on income tax thresholds. This would mean that as wages increase with inflation, more workers would be pulled into higher tax bands, resulting in greater tax liabilities. A freeze on the threshold for the higher 45% tax rate has already been suggested by Deputy Leader Angela Rayner in a leaked memo, with speculation that the freeze could be extended across all tax brackets. Sir Keir Starmer has not ruled out this possibility, which, while not immediately felt by the public, could yield billions for the Treasury as earnings rise. The current freeze is expected to push around 2 million workers into higher tax bands by 2028. Additionally, there have been increasing calls from the left wing of the Labour Party for a wealth tax, particularly following the government's recent £5 billion welfare U-turn. Rachel Maskell, a prominent figure in the rebellion that led to the shelving of significant elements of the welfare bill, has advocated for increased taxes on the wealthiest to fund the government's reversal. Polling by YouGov on behalf of Oxfam revealed that 77% of respondents preferred taxing the richest over cuts to public spending. However, implementing a wealth tax, potentially set at 2% on net assets exceeding £10 million, poses challenges and risks driving high earners out of the country. Starmer's Blairite policy chief, Liz Lloyd, has reportedly cautioned against such a tax due to concerns about an exodus of high-net-worth individuals from the UK. Consequently, it is anticipated that the Prime Minister will resist these growing calls. While Downing Street sources have indicated a wealth tax is off the agenda, there has been inconsistent messaging from ministers. Campaigners have long advocated for aligning capital gains tax with income tax rates, arguing that workers should not face a higher levy than those profiting from asset appreciation. Currently, capital gains tax is levied at 24% on most assets, while income tax rates can reach up to 45%. Labour MP Andy MacDonald emphasized the need for equity, stating, "Those people go out to work every day to keep our public service going, work in our factories, drive our economy. Where's the equity there?" Further proposals from Rayner include reinstating the lifetime pensions allowance, which caps how much can be saved in pension pots before incurring higher tax rates. The allowance was removed by the Conservative government, and Labour's initial plans to reinstate it were scrapped ahead of the election. However, given the backlash over the cutting and subsequent reinstatement of winter fuel payments, the government may be reluctant to introduce any measures that could anger pensioners. The Chancellor may also consider increasing corporation tax for banks, a politically palatable option as it has a limited direct impact on voters. However, banks in the UK already face substantial taxation, including a 25% corporation tax, a 3% bank surcharge, and a 0.1% bank levy on their balance sheets. Additionally, raising tax rates on dividends for higher earners has been suggested, although concerns exist that this could discourage investment in companies, ultimately impacting the economy negatively. Rayner has also proposed eliminating inheritance tax relief on shares listed on the smaller AIM stock market, a move that, while potentially uncomfortable for businesses, is unlikely to generate significant revenue for the Treasury. As the Chancellor navigates these complex issues, the pressure mounts to find a viable solution to the financial challenges ahead, all while adhering to Labour's commitment to protect working individuals from tax increases. That's all for this story. We upload videos every day covering many different subjects, so hit that subscribe button to stay informed. Thanks for watching.